What do you think about ESOPs?
I think right now, ESOP is this is something that we're playing around with right now.
Banks are not emotional creatures. They're
I,
big, logical, greedy, monstrous machines, and it's just the math doesn't work.
I will give you one tip. Okay.
Yeah.
And this is kind of my secret weapon. So,
Okay.
okay. Um, I think it's one of whenever you look at how people have made like massive amounts of money, and you look at the billionaires list, there's a lot of them that it's through acquisition one way or another.
Hello, and welcome to the How to Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling.
And now a moment for our sponsors. I want to highly recommend you get Acquisition Aficionado magazine. Every month, Acquisition Aficionado magazine brings you tactics for business buying and selling you won't find anywhere else. Learn firsthand from industry leaders who share their success stories, featuring in-depth interviews and stories from leading figures in the business acquisition industry. This multi-platform mobile magazine speaks to acquisition entrepreneurs wherever they are in the journey. And I want you to visit acquisitionaficionado.com today. Hello and welcome to the How to Exit podcast. Today I'm here with Matt Duckworth, and he is the CEO and founder of Rhapsodi, a financial services firm that helps early to mid career CEOs plan and execute roll-ups. So I'm very interested in this conversation. We've done some roll-ups in the past. We're working on one right now. I'm looking forward to learning from you today. Thank you for being here.
Yeah, thank you for having me. Happy to be here.
We always start off with the origin story. You and I were hanging out and chatting for a little while before we hit the record button. But so I know a little bit about it, but share with the audience who you are, where you're from, so they can kind of get a connection to you.
Yeah, so I hail out of Little Rock, Arkansas. The way that I kind of got into this business, my first job out of college was I was a music composition major and was staring at having no job prospects and started to cold call investment banks because at the university that I was going to, an investment bank came to speak, and I caught the presentation. I thought it'd be really cool, so I reached out to them, and through just happenstance, they had one of the places that I talked to had a new guy training program because a lot of the folks working for them were 50 plus and about to retire. So I kind of lucked into it. I worked really hard and ended up going back to school, doing the whole MBA thing, and came back and started doing fractional CFO services. And so the way that sort of led to acquisitions is I was sort of this deal guy who had worked a little bit on Wall Street. And in the firm that I was working at, I was kind of the only one who standing around who really knew what a deal looked like, soup to nuts. And I had bought a business kind of in that span of time as well, a small business. And so we had clients that wanted to do acquisitions, and that's how I got into it. And the first one that we did, I went and bought a book on how to buy a small business and read a bunch of stuff online and figured out, soup to nuts how to do it, and went from, help negotiate it, finance it, close it, integrate it, build the team, help to grow it. And so that was sort of my life as a CFO, helping other CEOs to grow through acquisition. And kind of like how I ended up in roll-ups is we had a client that we helped buy a manufacturing business, and he was trying to transition from his industry was changing. He was in a tangential market, so he needed to get into something else. We found a deal for him. We put the whole thing together, helped him buy it. It ended up being a really good deal. He grew it and doubled revenue, triple cash flow. Great story. And I was kind of on board after the fact to try to figure out, well, what do we do to take this thing to the next level? How do we keep growing? And our options, because it's manufacturing, it's either we got to buy somebody or we've got to build a new location. we started to research, okay, like if we bought somebody, what does it look like? Who are the players? We understood the market a little bit, but whenever you started to put the math to it and look at what does it do to our valuation and all that, it was pretty obvious this was a market that was pretty nichey. There was dozens of competitors nationally in that market, but there was maybe like 5 that mattered, and we had good relationships with all most of those 5, and started to acquire, and we saw what that did to the valuation, and it was just, for me, it was a light bulb moment. I've been doing all the pieces of that roll up puzzle, just helping companies to grow, but it was like I had the ingredients to the recipe, but I didn't have the actual recipe. And whenever I got kind of exposed to that, I realized this is the recipe. We need to really focus on the roll up. There's just not, if you're a good operator, a good CEO, there's not a lot of ways to build value faster with less risk. If you fit that mold.
A lot of people miss out on that. They miss out on the fact that there's a reason why private equity does this. There's a reason why people will go raise money for a fund from other people and then acquire multiple companies, glue them together, integrate them together, make them work, and then eventually exit and sell. And
Yeah.
it's because it's one of the fastest ways to grow a company. If a company tells me when I'm talking to them that they've grown 15 or 20% year over year and they plan on doing that for the next 10 years, I almost roll my eyes, right?
Yeah.
Because unless they're acquiring companies, because organic growth is really hard to predict how long
Yep.
you can continue doing something. I've talked to countless business owners who thought that they're going to continue growing the way they've always grown because Google ads are killing it for them. And I was like, yeah, that works until everybody else figures it out. And then the price gets auctioned up and it doesn't work no more.
Yeah, I
And
think the magic formula is if you can get some level of organic growth, you kind of control your own destiny, because then you can acquire, that you have a way to limit your downside. I think that there's like for a lot of CEOs who haven't acquired businesses before, there's a psychological barrier. There's like a fear of the unknown. They don't want to mess it up. They don't want to take a lot of risk, but it's the most de-risked kind of decision that they can make if they do know how to grow, organically.
yeah, if they're a great operator, that's critical, because you can take a company that's mid-level performance, stick a great operator in there and really tune it up. A lot of times these companies you're acquiring, they have great sales guy, or they're great in some area, but it's not in all aspects. I
That's
don't know
right.
how many times I've looked at a company and go, you know what, they don't do any marketing. They got 2 really good sales guys and they're got a great product and nobody ever leaves. So the reason they have the company they have is the customer retention is crazy. And they have 2 sales guys who have been there for 15 years, landing 1 or 2, 3, 4 clients a year,
Mm-hmm.
and they keep them because their product's good.
Yep.
What if they really did marketing? What if they doubled their sales guys? What if, we
Yeah,
put some
we've seen
brochures
this.
out there?
Yeah, we've seen this in IT. A group that we're connected to. It was 4 different business owners,
Mhm,
all in IT services, and one of them's great at marketing. One of them is great at just running the business, the operation side of it. One of them was really good at like systemization and automation, and another one really actually knew how to run the Salesforce.
mhm,
And they had kind of talked about, hey, maybe we should do a roll up. Whenever they ended up putting together, what you had at that point was, now instead of like one business that has one superstar in just one position, now you got a superstar in every single seat on the org chart.
mhm.
And it's really difficult for your competition to kind of mess with that and disrupt that, because you can't find that talent anywhere else,
Right.
or they'd be running the business. You couldn't hire them, right?
That's another thing a lot of people don't get is the best employees already have great jobs.
Yeah.
Right? If somebody's really good at what they do, they're already working somewhere. So how do you get, you know, You can go out there. Hiring great employees is difficult. It's always been
It's really
difficult. It's been
difficult.
difficult in almost every industry. I told you before we hit the record button, we were doing a marketing roll up. We talked to 200, 220, something like that, marketing agencies in a very short time frame. We had an extensive project going on where we were reaching out to them in every avenue we could, scheduling 1 hour calls. And you would think that marketing agencies would be really good at hiring people because they just had the market for the position being open.
Yeah.
But finding and retaining great talent was the number one problem almost all of them had.
Yeah.
Like if you asked what their biggest thing was, and that goes across the board. So
I agree.
acquiring a company and doing roll-ups, it's like, okay, I get to go hire, I'm a 50-person company. I want something in my size or bigger. When I do this acquisition or close to it, how do I go out and hire 30 great employees? I buy a company that has 30 great employees,
Yeah.
right? And I retain the employees.
Yeah, there's a lot of different reasons to do it. The kind of the math behind it is pretty simple.
Right.
In if you're in this lower middle market, like I'll just give you the example in manufacturing. Right now, about $1 million EBITDA business might sell for a little under 5 times EBITDA. I'll just use like round numbers to keep this simple. Once that a business, let's say it's stable growth, same kind of profile, once that business reaches that $10 million EBITDA range, you have way more competition from private equity because all the capital in the market, it basically coagulates to the top. It's the BlackRocks and the Blackstones, and then there's tiered down money managers who are
Hmm.
basically buying a business that then gets sold to a bigger business that then gets sold to a bigger business. So it's like the little fish that gets eaten by the bigger fish that gets eaten by
And they
the
all end
even
up
bigger
being
fish.
owned by BlackRock at some point.
Yeah, and so the BlackRocks of the world, whenever there's a deal that fits that size criteria, because remember they can't manage 1,000 different companies in their portfolio. They got to like be really selective because it takes so much time to make sure that the investment goes well. So whenever an opportunity comes their way that fits their criteria is big enough, in that part of the world, whenever you have very few opportunities, so you must put that money to work, or they're going to lose money from their investors because they're not deploying capital, right? And
Right.
then they're just sitting on cash, charging a fee on it, and investors. That's the number one way to lose assets under management is not deploy the capital. So they have this huge incentive to go out and buy more. And so, okay, you've got the $1 million EBITDA business that sells for 5x. Once it reaches that $10 million EBITDA number, it's now at around it's 9 to 10x, right?
Hmm.
So without any operational improvement, without nothing more than just combining companies and getting to the threshold and integrating them, they have to be integrated. Then you've now created a ton of value. So like let's use like an example where you deployed. Let's say that you bought, just really simple math, 10 companies, each $1 million in EBITDA, each at 5x EBITDA. So what
Hmm.
the math on that's like maybe $50 million
Right.
in total capital deployed. You can borrow 80% of it, right? So you need 10 million in equity.
Hmm.
And then you execute the integration, and at the end of that you can get, let's say, call the numbers 10x because you've got some growth to show, and there's a story there. You've just taken $50 million in capital and turned it into $100 million in capital, and you've done it with $10 million in equity.
Hmm.
And so you took the 10 million in equity and you turned it into 60. So the numbers get pretty compelling without having to. It's really about the integration, being able to find them, making sure that you keep key people on board, those sort of things. So I think it's one of the, whenever you look at how people have made like massive amounts of money, you look at the billionaires list, there's a lot of them that it's through acquisition one way or another.
I have people who will come to me and they'll say, "Hey, I've got this idea." They want me to fund it, is what it usually is, but they have got this idea for this product. And one of the things I try to convince people, 10 years ago, I wouldn't have done this, but now knowing what I know now, is I try to convince them is find a company that product would be an excellent additional line on their existing business,
Mm-hmm.
and then acquire the company. Now you've got a company with revenue, product market fit. You know that your product that you want to try or do would appeal to all the customers they already have, and they're loyal to that company. Now you can introduce your product, as a new item on that company. If it makes it, it makes it. If it doesn't, it doesn't. And if it doesn't, you own a company and your bills are paid and you're growing.
I
And
think it's brilliant. Yeah. Yeah, there's a lot of people that we've talked to. And we're working with somebody now who's going down this path, but hasn't fully executed it. But we've had a lot of conversations with people about, okay, I've got this new technology,
mm,
and one of the guys that we talked to a couple of years ago had developed a new type of security surveillance system that allowed you to use AI to like recognize people's faces and or if they had a gun, that kind of thing. And it was going to be a lot of money to bring it to market, and you'd still have to go through one of these security integrators. And so our thought was, hey, let's just buy an integrator.
mhm,
We have an instant customer, we have instant market feedback, right? And
mhm,
then we buy it at the right price. You're self-funding some of the growth, and now you have if you wanted to raise additional capital, you have revenue and a story to tell that
yeah.
makes it easier to get preferential treatment on the valuation.
It's such a key difference. A lot of people just miss out on. I'm shocked that it's not taught more at the educational level. Like at least when I did my MBA, I did. I have a master's degree in marketing, and I took some other classes outside of there.
Mm-hmm.
I don't remember ever being told, like, you should go buy a company. Everything,
Yep.
but I was in Silicon Valley at the time, so everything was about startup, startup, startup,
Yeah.
right? Go raise
The whole
capital,
environment.
VC funding,
Yeah.
that whole realm. But nobody said, you know what? If you go out and do that, you got to build it. You got to find the right customer. You got to do customer product market fit.
Oh my
You
gosh,
know,
it's
there's
terribly hard.
yeah, you've got a 1,000-piece jigsaw puzzle, and you're not sure you got all the pieces, right?
Yeah.
Like, somebody handed
That's a
you
good
the
way to put
box,
it.
it's been opened, you bought it at a garage sale, and you're like, "I hope this thing works." That's your typical startup, right?
Yeah.
And, and sometimes you're sitting there with a pair of scissors and a file trying to make a piece of cardboard fit in a spot because you're missing a piece. It's not the same, and I think I think it's starting to be now. There's a whole ETA programs in all kinds of schools. It was for a longest
Yeah.
time kinda reserved for the Ivies. Now I'm hearing all kinds of schools actually having, acquisition type of conversations and even ETA programs, entrepreneurship through acquisition programs in the schools. I know you were or are an adjunct professor. I
Yep.
did that for a little while. I did that, for a few quarters. I guess our school was in quarters.
Yeah, there's definitely there's an accounting for the risk reward between
Mhm,
like, if you're an ambitious person, you're thinking about should I build a startup? Should I buy a business? You're evaluating your options. And the startup world is really tempting, especially if you can raise some VC money. But the stats basically, I think this is a lot of people know these numbers, but the stats prove out that it's just far more. I think the default rate on SBA loans for these sort of acquisitions in most markets is under 2-3%. So you can kind of take that as like a failure rate. And for startups, I think it's like less than 1 in 10 make it more than 5 years. So,
yeah,
and the chances of if you can buy a cash flowing business that's been around for 10 years, there's a system in place that system has existed for 10 years. There's something about that system that allows it to continue to exist because it has passed that threshold, right?
right.
So I think it's way less risky. And if you're really into, like, I really love technology, and I have probably more ideas than I need, and so I love the idea of like Brad Jacobs is an archetype for this. And I really like what he's done, like with United Rentals and other companies like this. Is he applies that same kind of entrepreneurial thinking to the roll
Mhm,
up, but he's doing it to create an advantage, a moat. And that's the difference between the whole startup culture and the doing a real roll up. Is with the startup culture, it's more about let's build the tech sometimes, and it's not necessarily about the boat.
Yeah.
But where you want to get to is really have a big valuable business that has a moat. So I think the roll up with that kind of framework is probably the most compelling to me if you're thinking about it from a financial perspective.
So, it's brilliant to do a roll up and figure out how to fortify through a roll up strategy your position in the market, right?
Yeah,
Um,
I think that's secretly what Warren Buffett has done with a lot of the companies that he's supported. Is whenever he talks with the CEO, I spent a ton of time in Omaha, and
mhm,
I'm a shareholder, and I've been following Buffett for over a decade. And my dad got me into it whenever I was like in my teens. So I'll probably talk too much about Buffett, but one of the things that he's done, and I met some of his CEOs and people who he's worked with, he's buying a business that's not going to change a whole lot. He is doing bolt-on acquisitions that improve the moat, and they're constantly using acquisition to increase the moat. And what he's doing is he's reducing his cost of capital as they get bigger, and then he's also increasing the return on invested capital, so that the margin on each dollar of capital that he deploys is bigger as
mhm.
it grows. And that's what creates the compounding machine. And so I'm getting into some esoteric finance stuff here. I'm a finance guy by training, so I don't want to go too deep in it, but I think it's the most elegant solution. I'm kind of in love with it.
So, I often help other people do roll-ups, not quite from the financial point you do, mostly from the lead generation, start the conversation, build rapport with the owner, get them close to an look at the financials, but I hand those over to somebody way more talented than me to look at them, look at the numbers, and then we structure something and get it to LOI type
Yeah.
of thing. One of the things that I run into a lot of times when I'm talking to somebody who owns a decent business and they're like, I'd like to acquire a business, but I don't think I have the money to do it. How do I
Mhm.
fund this? What are
Yeah.
your I know you have a simple illustrated guide. I was looking through it. It explains how to fund these roll ups, how to fund an acquisition.
Yeah.
Uh, Share with us if you're a CEO out there, you're listening to the show, and you would like to acquire another company. They don't have to have $10 million sitting in the bank to go on a buying spree,
Right.
right? What are
Right.
the methods that you would help them as a CFO structure to make these deals work?
Yeah. And in most of these deals, there's going to be some level of debt financing from a bank, just as a baseline that we can kind of assume. And then typically the deal will have, a little bit of seller financing, not always in the form of a note, a seller
Mhm,
note. And then what the beauty of a roll up too is that there is a true story to tell about, hey, Mr. Business Owner, you're going to roll over 20% of your equity, and I'm going to make that little 20% worth 2 or 3 or 4 or 5 times more than what you can get for it now if you sold me 100% of the business. And so roll in with me, contribute your expertise. Maybe you sit on the board, maybe you're expert advisor, or whatever that looks like. And by structuring the deal that way,
mhm,
you'd be surprised how little cash you can come to the table with. I've done this with multiple deals, and we've closed deals approaching $10 million deals with less than a million, like 500,000 on a $9 million deal,
mhm.
and getting the money back within 6 months through cash flow. So there's ways to do it like that. And then the question is, if you're talented CEO, but maybe you've got your equity locked up, or maybe you don't have the cash to bring to the table. The truth about where we're at from a market perspective is there's a lot of cash, not a lot of talent, a lot of retiring business owners too. So if you're a young operator and there's a plan of how we're going to make this thing more valuable, that's realistic, that you can kind of prove out, then there is a whole host of family offices, private equity to an extent, but getting started, you wouldn't even have to go that far. There's a large network of people who want to invest $50,000, $100,000, $250,000 into these sort of roll-up opportunities and small business acquisitions. And so it's tapping into that network, and with a good opportunity, the money's there. There are fewer. There's a lot more money than good deals. I'll put it that way.
And a lot of people are, I mean, many of those investors, they're looking for great operators. They're looking for a horse to back, right? I hate to put it that way, but they're looking for somebody who they can believe in. They know they're going to get their money back because it's secure. You know, it's an up and running business. You're not asking them to throw money at a startup, an idea that doesn't have a proven market. You're
Mm-hmm.
saying, here's an existing business that's up, running, producing income, doing well. It's not mine to figure out. It's mine to screw up, and I haven't screwed up the
Yeah.
one I'm running already.
Yeah.
Right?
Yeah.
That's a different story for investors. It's like it's way safer. Yeah, it's not going to have the unicorn returns potentially that a startup. You know, the 1 in 100 startups. You have to invest in 100 startups to get the one that's going to make
Yep.
up for all 99 of the ones that failed. But you don't have to go through 100 of them to get one done. It's going to be a fairly secure transaction.
And you can structure those investor deals. This is sort of the point of some of the information that we've distributed is
Hmm.
with on roll up equity is you can structure. A lot of times investors get what's called a preference return. And so there's different ways to structure that, but
Hmm.
basically, their first capital in and then their kind of first capital out,
Right.
after the bank gets its money back. What that allows them to do is reduce their risk. In return, though, you as the CEO, if you're in that roll up leader position, can kind of capture upside above that. So if you're a great sales leader, and know how to, an industry, know how to grow a business, there's ways to capture a lot of that upside.
So we've talked a lot about if you're an existing CEO, you own a business and growing through a roll up. What if somebody out there who's an operator, they've got the experience there, maybe they've even had experience as a CEO in the past. They got a little money to invest and they want to go out and kick off a roll up. Are they just as able as the existing business owner to get these bank back transactions where 80% of it's a financial institution loan on the money? Or is that primarily kind of the world of you already have an existing business they can see?
Let's say that somebody was you use marketing firm. Somebody has been the COO or VP of operations at a marketing firm, and they've got a deal that they want to do. In my experience, I don't know how every bank in the world is going to think about this, but having true industry experience and then being able to say, "Hey, here is the business plan. I did this over here. Here's my experience. I'm going to apply the same playbook over here. The only major difference is I'm running the show and my name is on the note." The typical there's in terms of financing, there's different from maybe up to $5 million transactions, six maybe. You can even bump it to seven if you got creative. We would call that an SBA deal,
Yeah.
and which is really special. I think that that's kind of where most people end up starting, and those make a lot of sense from a CEO or a buyer's perspective, and if somebody's going to invest in it too. Once you get above that, the financing options kind of change,
Hmm.
and this space sort of between 7, 8, 9, and in 20 million, there's actually not a lot of people who play in that space from a lending perspective and investor perspective. And so what ends up happening there is a lot of creativity, seller financing, probably more equity you're having to bring to the table from friends, family, these people, this network of folks who are willing to write the $100,000, $250,000 check into a small business. And so it's a little bit more work, is my point. The rewards can be good because you still have very, very attractive valuations in that range typically. It's not quite where a lot of private equity's playing, but you're much closer to that hurdle where you get the bump in multiple because so much competition comes in from private equity.
I was hoping you were going to say something different. The
Yeah.
reason is I've interviewed quite a few people, and I was hoping you knew of a lot of people playing in that realm. There's a dead zone right now in that 7 million. You can do 5 million from the SBA, then you can do these what they call mezzanine loans and add-on loans and get close to 7. But from that 7 million to probably as big in a lot of industries as big as 50 million, nobody's really playing in that zone. I've been trying to get somebody from like one of the leaders from SBA to come on the podcast because I want to like have the conversation with somebody about what if right now you're doing the 75 or something like that percent guarantee on up to 5 million, which banks are
Yeah.
interested in. What if we just like why can't we look at things like let's just do a 60% on the 8, 9, and 10,
Yep.
right? And then go 40 or 50% on 10 to 15. If they would do that, banks would step forward. If you could just
Yeah.
reduce some of that risk, right? The only reason banks aren't in that space from say 7 million, 8 million to 50 million is the risk to reward ratio is not right for them. They have almost insurance level actuaries that know the math, know the risk, know everything about this, that know how to, they run all these models. They have very complex computer algorithms and spreadsheets that look at it and go, the risk reward isn't worth it, or they'd be there, right? That's just,
Yeah.
banks are not emotional creatures. They're
I
big, logical, greedy, monstrous machines, and it's just the math doesn't work.
I will give you one tip, okay?
Yeah.
And this is kind of my secret weapon. So
Okay.
okay. Um, there is an instrument called the industrial revenue bond. I have a very good relationship with an investment bank that I financed one deal using this. I've got one other that I'm looking at right now using this instrument. It's nichey. The deal has to check a few boxes, like it's got to be the right valuation. It's got to probably have real estate with it. There's a certain amount of assets that you need for this to fit. But what
Mhm.
this allows you to do is to issue tax-free and taxable municipal bonds through like a county conduit or something, but
Mhm.
basically to finance the acquisition. And so basically you're going through Wall Street to be able to issue debt. The beauty of it is, so this is one of the deals that we did was a 30-year amortization. There's a manufacturing business that owned some real estate and had big equipment, but it was a 30-year amortization. We financed 100% of the deal and then some for equipment expansion. The first year, no payments on interest. The interest was accrued. In years 2 and 3, we paid interest only. And so it allowed us to build up a cash hoard. But you can do these sorts of deals in that up to about $20 million range. There is a section of the IRC code that carves out what you can finance with this. So it's like niche, but there are carve outs too, where you can go above that, like waste management and a few others.
What
So
was the name of it again?
it's called an industrial revenue bond.
Industrial revenue bond.
Oh, I
Okay.
forgot to mention that when we did this deal, all those great terms, it was non-recourse.
Oh wow.
Yeah.
We'll have to double check on that one. And is it industry? Because it says it's industrial. Is it industry specific? Is there certain things you just can't buy with this, or?
It would be typically what's going to fit is a manufacturing operation or any business it's got cash flow. You have to have a certain amount of asset base
Mm-hmm.
to be able to do at least the tax free portion, and you have to have a certain amount of that, I think. So, but yeah, it's a really powerful piece of it, and you can combine it. This is the other thing too, is you can combine it with SBA. You can do some mixing and matching because whenever you're going through Wall Street, you're dealing with a much more. It's a different way of thinking about credit risk than a bank, and so they're much more flexible.
Is this something you just like reach out to the proper SEC attorney and say, hey, we want to structure this industrial revenue bond, and is there like, I'm trying to think, what's the
There are
process?
very few there are very few people who do it.
Hmm.
I can tell you, DA Davidson is one of the investment banks that does these. I know there are a handful of other investment banks that do it. If anybody's interested, they can I can connect them with folks.
Okay. It's intriguing. I always look for new areas to do things that we're trying to get done. So that's one I hadn't heard of before.
Yeah,
Let's talk about the different structures. I know when we created, I think the longest thing that it took us to do in that marketing roll up we were working on was to get the structure right. We spent quite a bit of money with the attorneys going back and forth, going, "What if we did X, Y, and Z?" And they're like, "No, no, you can do X, but Y and Z are going to mess you up." Okay, what if we
yeah,
do X, A, B, and C? And they're like, "Well, you can do, X and A, but B and C are going to mess you up." So we went back and forth, and we created a waterfall type of thing where
mhm,
what we did is the reason we landed. I told you before, we had like 26 LOIs within a short period of time, is because we gave the business owners, like, look, what do you believe your current valuation is? And as long as we could agree upon that, we locked that in, and we only participated in the uplift. So, you come in, you maintain your valuation, we take a percentage, a minority stake even in the uplift, so they get to keep the full evaluation of where they were at and a majority of the uplift, but we participate in a fairly significant minority of the. I don't know that I can disclose
I
what.
think if you can, I get what you're saying.
Yeah.
I think if you could pull that off, that's a really interesting way to do it. It's to get everybody teed up all at once and facilitate that. I know people have talked about that. It's hard to do, and you couldn't. I've seen people debate on, like, could you just flip it to private equity, and the guys that I've talked to at private equity have basically said, "Nah, we need to integrate it and have it."
We were
But
told 18 months of integration. They wanna see it working together for 18 months. So our goal was to get them all underneath the same roof, start the integration process, spend 18 months to 2 years ironing that out and making it look, congealed and working well together. And we were already talking I mean, we didn't build that without talking to private equity. We went out and said, "What do you
yeah,
want us to build?" Right?
I think
And
that's smart.
yeah. And we went out and we said, "What do you want us to build?" But we also, at that stage, went out to we had 2 people on our board that had done it before, had created, 500 plus $1 million marketing exits. One of them was in the
Okay.
Marketing Hall of Fame, and that's the reason when it dissolved, it was because 2 of the executives decided they wanted to do it on their own, and they convinced the 2 guys on our board that everybody wanted to work with. The whole reason we had so many LOIs is we had 2 rock stars, like, had done this before on our board and being advisors to them. They took those guys with them. So it's like, what are we going to do? We're going to tell these 26 people, no, stay with us, but you don't get to work with these 2 heroes you've looked up to your whole career. Right. So that said, our model was, hey, you get to work with these guys have done this before. They're your advisors.
Mhm,
We're your M&A team. We're going to go find the other companies. That
mhm.
was our role. And by the way, you get to keep 100% of your current valuation and a majority of what we create together.
I think that's compelling.
Yeah.
I've not thought about it like that, because what I kinda get I like to get control,
Mhm.
and that term, some people can say that, it's a turn off sort of word, but, deal control, you're in real estate, you kinda
Mm.
know, like, deal
Yep.
controls a lot of the game, and build a foundation,
Mhm.
and make sure that the first few pieces are working,
Yeah.
and then kind of grow from there. Because I've honestly, this is my confession. I've gone into some businesses right off the bat and
Mhm.
changed a bunch of things, and it just didn't work.
Yeah.
And typically, it's like cultural stuff. This people didn't fit, and so I've learned to be a little bit more patient about, like, trying to pull everything together all at once. And just that's my style. I
Yeah.
don't know if there's a good or bad to it, but
So that said, that we didn't get far enough down there to see how expensive it was gonna be if we had to roll somebody back or let them back loose, because that was gonna be a little bit spendy, because if you think about it, when you bring somebody underneath the umbrella, you're doing asset agreements, you're doing all this stuff, and then when you cut them back loose, you've already probably integrated some of their stuff. So now you got to figure out how to unintegrate their payroll, unintegrate
Yeah,
their, you
that's
know,
oh my gosh. I
yeah.
can't
So
imagine.
yeah, but
Well,
we
it's
it was one
I
of those we'll cross that bridge when we get there kind of thing. So we never got there.
it sounds really creative though on the legal side, and
Yeah,
that's a lot of the hard work. A lot
yeah.
of times is you're trying to. That was kind of a custom built solution for you know.
And the reason and the other thing is it depends on the industry. Marketing agencies actually have a huge problem in the fact that they can only get so big before they hit this artificial ceiling. So,
Yep.
in the marketing agency world, the big boys don't want to play with the little guys. So if you're a PepsiCo or a I keep using soda names. But if you're some big brand, you don't want some mom and pop guy doing your marketing because they don't have enough staff to move quickly enough.
Yeah.
So, problem if you're in marketing agency, you go out and you build this great agency. You're training employees from right out of college to being great. They start getting good enough. They're ready for a big company, right? They're ready to do a campaign for a Coca Cola, or a Pepsi, or General Electric, whatever, a big company. You just don't warrant the ability to land one of those contracts. So what do? You end up becoming a grooming ground for agents or a marketing employees, and they leave. They go work for the bigger agencies. So you're
Interesting. Yeah.
constantly trying to stop
Yeah.
that. So marketing agencies from 0 to 5 million in revenue or EBITDA is pretty straightforward for them. But at some point, they just get to where it's just hard to move forward any faster because in order to go
Yeah.
bigger, they need to be able to land bigger clients, and they're told they're not even big enough to bid. Like they don't even get in
Yeah.
the request for bids. They don't even get a seat at the table to make a pitch.
Yeah.
So we were solving that by look, you're part of this international marketing group. That's who you're going to go in and pitch at, and we'll send you tell us who you need on your team. We'll pull that from one of the other agencies. You guys go pitch it together, and you carve up the work. You do what you do, they do what they do, and we figure this out.
Yeah, and I imagine a lot of these agencies, they have leaders who are really good at the creative side of it, you know,
Hmm.
but not so great operationally. And
Yeah.
it's like, just, I would love to be able to offload this stuff to somebody else.
Yeah, it's not as easy anyway. So,
Yeah.
they were really disrupted and looking for opportunities. So that I think that played into it too. It's just one of those industries that is leans up to that. Another industry is kind of like that is I see a lot of people doing roll-ups in the financial spaces of bookkeeping and accounting firms. It's kind of a little bit of the same thing. The big boys want big accounting firms to deal with their stuff. They don't want to have a mom and pop accounting shop,
Yeah. They
right?
want a brand
They
to
want a
slap
brand.
on the audit. Yeah.
Yeah. So, these guys, they have an artificial ceiling to how fast they can grow and how big they can grow, because they can't land the big guys. They can't land the billion-dollar entities because they don't have the brand for it.
Yeah. Yeah. That's what was running through my mind,
Yeah.
because we had an accounting firm for a while that we spun off, but
Mhm.
it was, the fight for talent was real. Once people get to a certain level, they feel like I need to get, if you don't have a way to kind of stair step them up into something bigger and better, make them feel like, I'm creating all this value, let me share in it. And a lot of them are like practitioners, or sort of like not artists, but like craftsmen in a way, the really good ones. And so it's like they need another hill to climb, another mountain to top. So it's really difficult. So yeah, it's interesting how that
It's
works. And
same way in the market agency, right? You get somebody who's a creative and he's done the logo for his local pro shop, and he's done the logo for, the local restaurant, but he wants something to hang a tile on his name, right? He wants to
yeah,
redesign a logo or create a logo for some name brand that, will write a ticket for him on his resume. And you're not going to get that I don't care if you got the best logo designer in the world. Coca-Cola decides to land a new flavor. They're going to go have three different agencies that have 500 employees bid against each other and maybe even do a little competition to see
yep,
who wins the design and the rollout, right?
yep.
So it's a tough gig, and a lot of industries have this. So that that leans to the roll up strategy too. If you can find an industry that has some form of barrier that they can't break through unless they're bigger, the
Mhm.
you're not big enough to play. One of them would be the accounting. Like, you're not big enough to play, be the accountant for Lockheed Martin. Picking a name that's not a Coca-Cola here. You're not going to be the accountant for Lockheed Martin if you have 13 employees at your local Tulsa, CPA firm,
Yep.
right? They're just not going to do
Yep.
it. There's a play inside of that that says, let's make you bigger.
Yeah, I think that there's
Yeah.
something there. I've always thought that if there was somebody who could basically build a company to in that accounting finance space to and do a
Hmm.
roll up, but make it such that the game plan was to basically like give everybody a piece of the equity who's like a key employee, and then create some kind of liquidity event. Like, I don't know, IPO. I hadn't thought to past that point because there's a lot of different ways to go, but that speaks to my heart because that's kind of how I started Rhapsody. Is I felt like there wasn't a whole lot of places that I could go at my current employer that was very interesting. We were kind of tapped out, so I had to start something myself to be able to scratch that itch.
What do you think about ESOPs?
I think right now, ESOP is one of the. This is something that we're playing around with right now. I
Yeah.
think that there's one of the pitches that we've made recently to a business owner he was very manufacturing firm, very concerned about his employees and treating them well, and making sure that we weren't going to
Hmm.
like move operations to China or something like that. One of the things that we have started to model out is, we buy the business and structure it as a roll up, but there would be over a certain period of time an ESOP for about 51% of the business to bring those employees in.
So,
And then we would be able to take money out, reinvest it into other stuff. But now we've got committed folks, and we get the valuation bump from the ESOP. Right now, there's a little bit of delta there, so
hmm
it's expensive to do if it's a small deal, but I think it's interesting.
so I've had a play that I keep kicking around that if I do another one where I'm the leader of, or a key player in and not a minority stake, like I do a lot of things where I'm the minority
Hmm.
stakeholder and I'm just helping out, because then I put in a few hours here and there for them and get them what they need, and got a lot more leeway with my
Yeah,
time. When I'm ready to kick off something where I'm going to pull a lot of hours to get it done, I think there's a play out there to do. It's a roll up strategy, but you're committing to the business owners that within a certain period of time that you'll sell it to an ESOP.
yeah.
And I think it needs to be a decent sized company. And I think a lot of business owners are out there that would love to see their employees own it, but they have the realization that they don't have the time or skill, and the employees don't have the knowledge to run the company. They don't have the time or skill to train the employees to be great operators, and the
It's
employees
a
lack.
big problem once, yeah. Once an ESOP, once you have a business owned 100% by the ESOP, you have all of these weird agency problems where it's like they don't have any. One of the guys who's an advisor for us he's been in manufacturing for like his whole career
Yeah.
as an engineer and has worked for a bunch of ESOP companies. And like one of the CEOs who he worked for, this is maybe $300 million business, 100% ESOP. The CEO owned shares in the ESOP, but he didn't want to change a whole lot because it was like, all I got to do is ride this thing out, and I can sell back into the ESOP, and I'm good. If I do anything to mess it up though, then it impacts my retirement. And he didn't want to mess it up.
Yeah.
And so I think that there's this play for, you sell 51% or something to the ESOP, but then you have dedicated real management who's going to lead the business. And you need true visionary leadership, I think.
So the goal that I was looking to do is, I've interviewed so many people. One of the teams I've interviewed, they've acquired 60 plus businesses. They teach people how to be great operators and great employee operators. There's a book. It's semi popular. I mean, it was big a long time ago. Now they've got some new versions of it. It's called The Great Game of Business. Have you read that?
Yeah.
So the
Yep.
guys that wrote The Great Game of Business, I've interviewed them, and they've acquired 60 plus companies, mostly in the manufacturing
Yeah.
space. And they actually have a training program that teaches people how to be great operators. So my play, I'll just throw it out there because I'm a believer in the blue ocean strategy. My play was to go to business owners, say, look, if you're what would love to see your employees run in this company, I'll commit, we'll come in, we'll raise a little capital, we'll buy that business out, set you up for retirement. We'll bring in the right training, and their training's not that expensive. I think you can train a group of 4 or 5 executives for under 6 figures or right at 6 figures.
Okay.
Like 100 grand will train the top 4 or 5 execs. We'll train the employees to be great operators. We'll sit with them and, for the next 3, 4, 5 years, whatever it takes until they show that they're great operators. And then we'll guarantee that we'll sell some majority stake, maybe 50, 60% of that over, but we'll also reserve a board seat and some control over the company to be advisors to them over time. So our
Mm-hmm.
parent company, our holding company, will have boards, and advisors to make sure that it's taken care of, and we'll maintain some type of minority stake in there. With you can have a minority stake and a say. We have two.
Yeah.
So we just make sure that we maintain enough seats on the board, and our minority stake at 40% is probably the biggest stakeholder that the company will have. So we'll have still maintain control, right? Because the rest of the 60% is just all the employees put together could outvote you, which is very possible. And if so, it probably needed to be done, right? If you get outvoted in that scenario, you're probably doing something you shouldn't. And that would be the play. And I think there's room for it out there. I honestly think that there's a lot of
I think
people.
that you're I think that you're onto something that just seems really has always seemed strange to me. We have a educational system that's it you have a very clear path and you read books and stuff and you do these assignments in class, but it's not like learning by doing,
Mhm.
right? But like if you got into career, if you went to work for a manufacturing plant in Germany, you'd be an apprentice. And there's a craftsmanship. I think that entrepreneurship is the same way.
Mhm.
I think that anybody can probably be an entrepreneur if you just give them enough time because it's a skill set like playing the guitar,
Oh yeah,
right?
absolutely.
Or like, we were talking earlier before we hit record about martial arts, it's a you got to work at it. And I think what makes a huge impact, it's made a huge impact for me is getting to work around people who are, a level up from where I'm at so they can show me here's a different way to think about it, or here's how you handle that situation. And so if I were a business owner, I'd be curious what listeners think about this idea because I think that there's something to it. If I was a business owner and I really cared about my employees and I wanted this thing to continue on into the future and like I've got my little DNA stamp on it, I would want some kind of mechanism for those people to be mentored,
Hmm.
right? But that's not going to happen unless there is a structure in place to make it happen,
Right.
right? It has to be planned on, and built into the system, or just you, how would you rely on it happen? So there's something there. I think that's compelling.
Yeah, you just commit to them, say, "Look, we'll take control of it now. We're gonna bring a company in. They're gonna train all the employees how to understand balance sheets, income statements, how their individual daily role impacts everything, and we're gonna give them some decision-making power. We're gonna put some of that employee stock ownership benefits in it, meaning there's going to be bonus structures and stuff based on performance. That's one of the things the game of business does is it gamifies everything. So there's going to be a financial incentive from the day after we get them trained on this, and then over time when it shows that they're ready, and I think we'd have to commit to a certain time within X number of years. We'll make the transition. We'll actually spend the money, have the ESOP come in, and we'll sell X percentage of the company to that ESOP. And
Yeah, I think that this whole giving the I'm really passionate about this. You brought up something that I've been working on this
yeah,
in the background of how do you give the blue collar worker a piece of America again.
hmm
I think this is a really important and powerful message is because I don't know if you've seen the chart. Since we got off, Nixon took us off of that gold standard benchmark in like 1971. And since that time, the disparity between the rich and the poor, the chart looks like this,
Mm-hmm.
and so, like the cost of education's gone up. You know all the stats. It's a real problem if you look back at history. Every time that dispersion has gotten too wide, there's been some kind of major breakdown or revolution or change in government. And I think that the whole system has been set up to make the rich richer and keep everybody else kind of where they're at. And I'm a capitalist, but I think that you ought to bring people along with you. And I think that it's probably smart business too, to give them a piece of the pie.
There's a
So,
third component inside of this I think business owners care about, and a lot of these business owners know that their business is a cornerstone to the little community they set it up in. A lot of these
yeah,
businesses are in rural America, and they're
yeah,
the major employer for 30 or 40 miles.
yeah,
And they don't want to sell to somebody that's going to do a roll up and then, move the entire thing to Dallas because, it's just a bigger city and that's where one of the bigger companies is. By
that's right.
guaranteeing it's an ESOP, you give the employees the say, at least, what happens when we acquire this other company. They're going to, are we going to operate separately, or are you guys going to move? Who wants to move? Who needs
Yeah,
to move? So you're not only protecting the employees, the legacy, your brand and name that you created and put your heart and soul into. I guess that's legacy, but you're also, adding some component of protection for the community, because you,
yeah, and it's really important.
yeah, you're guaranteeing to that, you know, owner, we're going to give your employees a say what happens with the future of this company once we hand it to an ESOP. And you'll have to have some type of provisions in there that you won't sell it or do anything else to it before they have their say.
Yeah, I think the challenge of we got a few clients that are in the very rural areas that we've worked with, and the challenge is getting all that human capital, that knowledge
Hmm.
to the town. It's hard to recruit there, and so a lot of that, like you said earlier, is like bringing in training. I think if you could bring in world class training and mentoring to these rural areas, there's a lot of government money to support rural development. There's the that industrial revenue bond program that I told you about
Hmm.
supports that as well, because you've got to make the commitment to that location,
Hmm.
and that's a long term commitment. So there's I think the combination of those things that you're talking about is what maybe there's some magic there.
Well, we're running out of time, so maybe we should carry this conversation on at another time. Maybe I can figure something out to solve this problem for
Yeah,
rural America businesses. Before we go, though, before
thank
we
you.
call it a show, let's make sure everybody knows how to reach out to you and work with you. So, what's the best way to contact you?
Best way to contact me is through either LinkedIn,
Hmm.
and they can just Google my name and they'll see Matthew Duckworth, and I'm the roll up guy on LinkedIn. Or if somebody wants to reach out directly, they can. I'll give out my email address, and it's Matt MATT at rhapsody.net, and Rhapsody is RHAPSODI. So I instead of a Y.
And you actually have a little PDF that you gave me to share with that. I'll put that in the show notes too. But it shows the what a roll up strategy looks like illustrated. So it has the different structures and preferred stock versus different things, how it's funded.
Yeah,
It's a great PDF guide to get, a primer to get somebody kind of thinking about this. So I'll put
yeah,
that in
very
the show notes.
simple illustrated guide. Yep.
Yeah, I'll make sure that's in the show notes too. Well,
Yep.
let's call that a show. Let's wrap this up and hang out for a few minutes and we'll chat.
Great. Thank you.
I want to announce our new channel partners, the ITX Marketplace. Since 1998, ITX has created $5 billion in value by selling more than 225 IT businesses in 20 countries. ITX works exclusively with IT-enabled businesses generating between 5 million and 30 million who are ready to be sold, and M&A decision makers who are ready to buy. For over 25 years, ITX has developed industry knowledge that helps determine whether a seller is a good fit for their buyers before making the match. ITX Mergers and Acquisition Marketplace we have partnered with has a proprietary database of 50,000 plus global buyers seeking IT service firms, managed service providers, Microsoft service providers, software as a service platforms, and channel partners with Microsoft, Oracle, ServiceNow, and the Salesforce space. If you have an IT-enabled business you're ready to sell, I want you to visit the itexchangenet.com/marketplace. How to exit. That link will be in the show notes. Visit them now.